If you look at the end of first quarter, markets have done reasonably well. 2018, as all of us know, has been a very tough year for the broader markets. However, this year, markets have started well. The other feature is mid-caps and small caps, which had performed disastrously in 2018, have shown some recovery over the last 4 to 6 weeks. Large caps also recovered very smartly, particularly again over the last 4 to 5 weeks, primarily because of strong FII inflows that we saw. So markets have done well. Over the next 2 months, I know the focus is going to be on elections. So I believe the markets will remain choppy and one should, navigate the markets very, very carefully. 2018 was a negative year in terms of FII flows, and I'm sure some of you recall that the last time FII flows were negative in a significant manner was year 2008, which was the global financial crisis year. Compared to that, I think this quarter has begun extremely well for FII inflows. If you look at the number, I don't have the full number yet, but $6.5 billion of FII inflow in the first quarter, of which more than $4 billion has come in the last 4 weeks itself. So very strong buoyancy in FII flows. Now, I don't think this is India specific. If you look at other emerging markets have also done well and have received flows. That happened in the beginning of the year. Over the last 4 weeks, in a way, Indian market is catching up. I mean, as far as the full year is concerned, it really depends on what happens in the global economy. But if US dollar index were to weaken from here, the expectation is that the FII flows into the emerging markets will continue to be buoyant. I think the biggest story in this year and next few years is going to be a strong recovery in earnings growth. As all of us know that last several years, earnings growth has been fairly stagnant. What we are going to witness from this year, that is FY20, is a significant recovery in earnings growth, not only in large caps, but also in mid caps and small caps. Sectorally, if you see, the sector that will probably do the best in terms of earnings growth will be corporate banks, which have actually dragged the overall earnings growth over the last several years. But now going forward with recovery from NPLs and in general economy starting to do well should benefit corporate banks a lot. We know for quite some time that small caps and mid caps have done disastrously. As all of us know, 2018 was the worst year on record for small cap and mid cap performance compared to large caps. So it was expected that that will reverse. These things, however, require a trigger. We got that trigger about 4 to 5 weeks back, and we have seen small caps significantly outperforming large caps and mid caps also outperforming large caps. However, now that we are heading into or we are into the pre-election season, I will not extrapolate that. So I will not believe that this is it and small caps will continue to outperform, which I believe will be true from a medium to long-term perspective. But in the very near term, I will still be cautious because of the volatility ahead of elections. At this stage, we are overweight on sectors such as industrials, which is a very large sector comprising of construction, industrial products and so on. And we are also overweight on corporate banks in particular. On the underweight side, we are underweight FMCG and we are underweight IT services and telecom. In terms of sectoral bias, wherever we are allowed to change that, particularly in multi-cap fund, we are moving more and more towards small caps and mid caps after being very large cap heavy through last year. In my view, investors should obviously focus on the medium to long term because equities is a long-term asset class. And the most important thing from a long-term perspective for equities is what is happening to the underlying earnings growth. We believe that underlying earnings growth trajectory is definitely improving after stagnating for several years. If you look at the broker estimates, FY20 over 19 earnings growth estimate is about in excess of 20%. I would believe that anything in mid to high teens will be good. So medium to long-term prospects, I think investors should be looking at getting into equities as an asset class. However, because over the next 2 months there is bound to be volatility because of elections, etc., it's better to have a staggered approach to investment. But the most important thing at this point of time to ask is whether you are underweight on equities. I believe that you should reduce your underweight on equities significantly.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.